Interest rate swaps are fundamental instruments in the financial markets, and they're used equally by financial institutions as well as corporate clients. Now, one use is to manage basis risk. Now, when you hear the word basis, mentally substitute the word index. So, a mortgage lender would run a basis risk if he borrows on a floating rate or variable basis, where rates can go up or down from one month to the next, and when they lend on a fixed rate basis, again, where the income stream won't change. So, what could possibly go wrong? Well, as long as his borrowing costs are lower than where he lends money out, obviously he's going to make a profit. So the worst thing that can happen is that you have something like a currency crisis maybe, and short-term interest rates shoot up. And so this means his borrowing costs might go through the roof, and his problem is he can't change the rate on the loan he's made. Now, these things do happen, and in America in March 1977, so way back, prime rate was 6.25%, and just 3 years later it was 19.5%. So imagine if you'd given out fixed rate loans then. So what happens is that larger banks have a group called ALM. Now, this is the Asset and Liability Management team, and they're responsible for managing the risks to the bank of borrowing and lending. So it's not just about interest rates, but about liquidity. Do I have access to funding? Now, when short-term interest rates are lower than long-term rates, the ALM guys call this 363 banking. So you borrow at 3, you lend at 6, then you're on the golf course at 3. It's pretty easy money. But what if interest rate costs start to rise every week or every month? Now remember, the loan on the other side is fixed and it can't be changed for say another 5, 10, 15 years. This is where we'd look at doing an interest rate swap. Now the bank would continue to receive fixed on its loan, and it will continue to pay a floating rate of interest, whether it's 1% or 1,000%. Now the good news is that this payment will be exactly matched by the swap counterparty, maybe another bank, and in return our guys are going to make a fixed rate payment to the swap counterparty. So the bank is completely immunized or protected against short-term interest rate moves. It really doesn't matter where they go, you're paying fixed. So the bank has swapped its debt or liability from a floating rate basis to a fixed rate basis. Now, as long as it receives fixed at a higher rate on the loan than it's paying on the swap, then the bank's locked in a profit. Now, in practical terms, the dilemma that an ALM desk will have is that long-term rates are typically higher than short-term rates. So by moving down the curve, as we say, and paying fixed, the ALM desk is losing the opportunity to earn an extra amount of interest income by what we call funding short, so funding a long-term loan at short-term rates. Now what they'll do is they'll normally figure out the optimal mix between the fixed and the floating amounts of debt they should have, looking at how many earnings are at risk in case rates do start to move against them.